My today's topic is about Kiddie Tax, which is imposed by the Internal Revenue Service on high earners who assign their income to their children to lower their tax liability. Education builds a nation, and education builds your reputation. Therefore, focus on education. This is my message. Hi, this is Nashima, the CEO of InfoTaxSquare.com. I recommend professionals and students to sign up with GLIME to enhance their knowledge, particularly those who are planning to participate for EA and CPA exam to sign up with GLIME. I also request that those who watch our videos subscribe to our channel to receive up-to-date taxation information in their email. Why should you subscribe to our channel? We are a team of CPAs and EAs who develop content based on Congress, IRC codes and IRS publications. Let's start with the objective of Kiddie Tax. What is the objective of Kiddie Tax? The Kiddie Tax is intended to prevent high-income families from using their children's lower tax brackets to lower their overall tax liability by taxing substantial unearned income at the higher rate of the parents. It closes the loophole where income could be transferred to children to receive lower tax rates. In short, the idea to impose a Kiddie Tax under the Internal Revenue Code to fairly charge tax on the assignment of income. There are 4 steps to be followed to calculate Kiddie Tax. Number 1, dependents will pay tax on earned income based on their own marginal tax rate, not their parents. Number 2, in 2024, the standard deduction of $1,300 will be applied to the dependents' unearned income such as interest or dividend or passive income to reduce it. Every year, inflation causes the standard deduction to change. It changes every year based on the inflation. Number 3, the next $1,300 will be taxed by dependents according to their own marginal tax rate, such as 10%. Number 4 point, the parents' tax rate will apply to anything above $2,600. I'm going to explain the Kiddie Tax with an example. Let's imagine Jane, who is currently 10 years old, her lemonade stand generates $500 for earned income, while her trust fund generates $3,000 of her unearned income. What is the difference between earned income and unearned income? Earned income is derived from the operations such as you receive from the wages, tips or commission, where unearned income comes from the investment such as dividends or interest. So in this case, she has earned $500. On $500, she is going to pay taxes on her own marginal tax rate, which could be 10%. Since she is a dependent, so her tax rate would be very low, maybe 10% tentatively. On the other $3,000 unearned income, she is only allowed by the IRS to utilize $2,600. So $1,300 is a standard deduction on which she is not going to pay any taxes, whereas on the next $1,300 she is going to pay 10% taxes. So she earned $3,000 in unearned income and $26,000 she has utilized. So she is leaving $400 on which her parents will pay taxes on their higher income tax return. I'm going to explain it in detail. The first unearned income will be reduced by $1,300 standard deduction, leaving unearned income at $1,300. $3,000 minus $1,300 is standard deduction. Jane will subtract $1,300 from her earned income, which she will pay tax on. So next $1,300 she is going to pay 10% taxes. Jane can lower the unearned income maximum by $2,600 in 2024 due to the Internal Revenue Service permission. In this case, Jane will pay 10% on $1,300, which $130. Since Jane is allowed to reduce unearned income in year 2024 by 2,600, the parent's marginal tax rate is applied to anything over 2,600, which is $400. $3,000 she earned in gross, minus 1,300 she utilized as a standard deduction, and next 1,300 she is going to pay taxes on her marginal tax rate, which is 10% tentatively. Parents will calculate tax based on 35% marginal tax rate for $400 or 1,700 minus 1,300. They will be responsible for paying $140 in taxes. $400 multiplied by 35%. In short, there is no tax on the first $1,300. Jane is responsible for paying a 10% tax on the next $1,300. Lastly, the tax rate of Jane's parents, which is 35%, is the responsibility of paying tax on $400, which is $140. Now let's just take a look on characteristics of Kiddie Tax. The Kiddie Tax prevents parents from transferring income to their dependent who are more likely to face higher marginal tax rate. The Kiddie Tax primarily targets unearned such as interest, dividend, and capital gains from investment, but it is not exclusive to investment. It can also apply to other forms of unearned income such as royalties or rent. The child tax rate applies to unearned. The child tax rate applies to earned income such as wages from a job. As in the previous example, Jane earned $500, so she's going to pay tax on her wages or from regular income based on her own marginal tax rate, which was in the previous example for 10%. The parent's higher tax rate will apply to any gross earned income about $2,600 for that dependent child until it matches their taxable income. The Internal Revenue Service uses this method to ensure that those sneaky income shifts don't slip past the taxman. Any income above that threshold will be compensated for charges presumably lower rate. When the child taxable income surpasses the net earned income, they are taxed at the child tax rate, which is lower than the parent's tax rate. The Kiddie Tax is the tax that is levied on child's investment and unearned income, commonly referred to as the Kiddie Tax. The purpose of it is to prevent from giving investment to their children to take advantage of their lower tax bracket. Here we have some examples of unearned income to determine Kiddie Tax. Okay, Kiddie Tax is only calculated on the investment income, such as taxable income, such as taxable interest, dividend, not taxable income, sorry. So Kiddie Tax is only calculated based on the investment income, such as taxable interest, dividends, capital gains, income produced by gifted assets from grandparents, debt cancellation, pensions and annuities, social security, royalties, taxable scholarship. Whereas Kiddie Tax is not calculated on the regular income, such as salaries, wages and tips. Here is another example to show income that is subject to the Kiddie Tax and no earned income or unearned income. The idea behind Kiddie Tax is to prevent parents, those who assign or transfer or shift income to their children, to avoid paying taxes. Julie is a 15-year-old dependent child who has received $5,500 of dividend on common stock that she received as a gift from her grandparents. How much of her income will be subject to the Kiddie Tax? Based on the Internal Revenue Service, Julie can maximum utilize $2,600 against $5,500, which is the earned income. On first $1,300, she is not going to pay taxes because $1,300 is her standard deduction, whereas on next $1,300 she is going to pay 10% taxes, which is Julie's marginal tax rate. So she's going to pay only $130 taxes and leaving $2,900 taxable income for her parents to pay taxes on their higher tax rate, which is 35%. So subtracting 2,600 from the from 5,500, she's leaving taxable income 2,900. On 2,900, her parents are going to pay taxes based on 35%, $1,015. Here is another example to demonstrate how earned income is treated to determine taxable income and tax for children. Ricardo, who is 14 years old, worked part-time earning $2,000 and received $3,300 in interest on corporate bonds. How much tax is due on Ricardo's income, assuming his marginal tax rate is 10% and his parents' marginal tax rate is 35%? So in this case, Ricardo has earned total $5,500, which is a combination of $2,000 is from his part-time job. Active income $3,300 is a passive income he received from the investment income, from interest income. As we have already studied that we calculate the kiddie tax on earned income only, not on the regular income. So now we have his total income $5,500. In order to calculate what is the total taxable income, we need to determine his standard deduction. To calculate the standard deduction, we have to compare the $1,300 regular standard deduction, which is allowed by the IRS, with $2,000 he's earning plus $450 which IRS has allowed. So we have to compare $1,300 plus $2,450, and whichever is higher, we'll consider it as the standard deduction. So now we know Ricardo's total income is $5,500, his standard deduction is $2,450. So now we have calculated his taxable income is $2,850, which includes earned income and unearned income. Now we have to split $2,850 between his marginal rate and his parents' marginal rate. His parents' marginal rate is 35% and Ricardo's is 10%. So now first we have to determine his parents' taxable income. So as I just mentioned, that we only calculate the kiddie tax on the earned income. So Ricardo had earned $3,300 from interest, which is a passive income, and we are going to reduce it with $2,600 with the IRS allowed in order to calculate the kiddie tax. So $3,300 he total earned, we have to reduce, which is allowed to Ricardo to utilize in order to calculate the kiddie tax. So his parents are going to pay taxes on earned income, which is $700. $3,300 minus $2,600 is equal to $700. And his parents' marginal rate is 35%. Therefore, they are going to pay $245 taxes. Now we have determined his parents are using $700 of earned income, and above we have calculated the total taxable income was $2,850. So $2,850 we have to reduce with the $700, which is shifted to his parents to pay taxes based on their earned income, which is based on their income, which is 35%, resulting $245. So now we are going to reduce $2,850 with $700. So the Ricardo is subject to pay taxes on $2,150, which is a combination of $2,850 taxable income minus $700 of earned income. So his share is to pay taxes on $2,150 at the rate of 10%. So he is going to pay $215 in taxes, and his parents are going to pay taxes for $245. Now I'm going to summarize the entire topic of Kiddie Tax, what we have learned so far in this topic. What is the objective of Kiddie Tax? The objective was to impose taxes or restriction to those parents who transfer or shift their income to their children to avoid paying taxes. There are 4 steps to be followed in order to calculate Kiddie Tax, and Kiddie Tax is only calculated on the unearned income, not on the earned income. So unearned income includes taxable interest, dividends, capital gains, income produced by gifted assets from grandparents, debt cancellation, pension and annuities, social security, royalties, taxable scholarship. Whereas Kiddie Tax does not apply to salaries, wages and tips. And remember, first $2,600 is a combination of $1,300 standard deduction, on which the taxpayer does not pay any tax on first $1,300. On the next, because the IRS allows the total $2,600 to the dependent to utilize against earned income. So first $1,300, the dependent is not going to pay any taxes, whereas on additional $1,300, the dependent is going to pay taxes on his or her lower taxes, which is tentatively usually 10%. And above $2,600, whatever the balance in taxable income, the parents are going to pay taxes on their marginal income tax rate, which is higher. I thank you and God bless you.